Welcome to the deep dive. Today we're tackling something really timely.
We are indeed.
It's about how these global trade tensions, specifically tariffs, are maybe shaking up the stock market.
Right. And we've got an interesting angle from The Motley Fool, an article published, just yesterday? April 22nd, 2025.
Exactly. And the surprising part, the thing we really want to dig into, is why this piece points to Netflix as maybe compelling buy right now, with all this uncertainty swirling around.
It's definitely a counterintuitive idea at first glance. So if you're listening and trying to figure out these market swings, these tariff impacts.
Yeah, and looking for maybe some investment ideas that won't get totally battered.
Well, this article offers a fascinating case. So our goal today is to really unpack the arguments. Why Netflix? What's the logic?
Okay, let's set the stage first.
Yeah.
The article kicks off talking about the recent Nasdaq bear market. For anyone not glued to the charts, that means a pretty significant drop. The Nasdaq 100 was down, as much as 23% from its high?
Yeah, firmly in bear territory. And a big piece of that puzzle, according to the source, is these global trade tensions.
Right, the tariff the U.S. has put on imported goods.
Yeah.
So what usually happens when investors get spooked like this? What's the standard reaction?
Well, typically you see a move towards caution. Big macroeconomic uncertainty like, potential trade wars. Investors often dial back their stock exposure.
Less risk.
Exactly. They might shift towards safer assets. Cash, for example, can look more appealing while everyone waits to see how things shake out.
A flight to safety makes sense. But okay, here's the twist the article presents regarding Netflix. These tariffs everyone's worried about, they mostly hit physical goods coming into the country.
And Netflix? Well, what are they selling?
Subscriptions, right. Access to digital stuff, movies, shows.
Precisely. Digital content. It's not a physical product crossing a border that gets slapped with a tariff.
Ah, okay.
So their core business, that main revenue stream, it's just, it hasn't been directly hit by these specific tariffs so far.
So that digital nature gives them a kind of shield.
It does seem to provide a layer of insulation, yeah. Think about it. A company importing widgets might have to eat the tariff cost, hurting profits, or pass it on to you, the consumer, potentially losing sales. Netflix doesn't face that exact pressure from these tariffs.
Interesting. So they sort of bypass that specific problem. But the article mentions another strength beyond just being digital, their global reach.
Oh, absolutely. This is huge. Netflix operates in, over 190 countries?
Wow.
That scale gives them incredible revenue diversification. If one country's economy slows down, or, hypothetically, if some government did try to penalize digital goods down the line...
Which hasn't happened with these tariffs, we should stress.
Right, not with these. But if it did, Netflix isn't solely dependent on any single market. They've got revenue streams flowing in from all over the globe. It's a buffer.
And despite all this market nervousness, the article highlights something from Netflix's recent earnings report, Q1 2025, just out last week.
Yeah.
They kept their full-year forecast unchanged.
Yeah, that's a pretty strong signal, isn't it?
What is that signal, really? Maintaining guidance when things look shaky.
It suggests confidence from management. They're essentially saying, look, despite the broader economic headlines, we believe our business plan for the year is still on track.
So internally, they don't seem to see these specific trade issues derailing their projections.
That's the interpretation, yes. For an investor, you might read that as resilience, stability. But, it's still a forecast. Things can always change.
Of course. Now, how has the stock actually performed? The article noted that when it was written, Netflix stock was only down about 8.6% from its all-time high.
Which sounds like a drop, but compare it to the Nasdaq's 23% plunge.
Right, it's significantly less severe. What does that relative outperformance tell us?
It suggests the market is perhaps recognizing some of this insulation we're talking about. Investors might be seeing it as maybe a safer place to be compared to companies more directly exposed to tariffs or supply chain disruptions.
Okay, so there's some market validation of the idea. The article then really hammers home Netflix's dominance in streaming. The subscriber numbers are staggering.
They are. End of 2024, they reported 301.6 million paying subscribers globally.
300 million. And the competitors?
Well, estimates put Amazon Prime Video around 200 million, Disney Plus around 125 million. So Netflix is comfortably in the lead.
Even though they stopped reporting those subscriber numbers every quarter now, right? They focus more on financials?
Correct. The shifted focus to metrics like revenue and profit. But that massive existing subscriber base is still a huge advantage.
Why is scale so critical in streaming?
Well, more subscribers mean more consistent revenue, and that revenue lets them invest heavily, massively in content, which in turn attracts and keeps subscribers. It's a powerful flywheel effect.
And the money's certainly flowing. Q1 2025 revenue hit a record $10.5 billion.
Yep, up 12.5% from the year before. And interestingly, that growth was actually better than their own forecasts.
What drove that beat?
According to the article, it was a combination of higher subscription revenue and growing advertising revenue.
Ah, yes, the ad tier. That seems to be becoming a bigger piece of the pie.
It really is. Launching that lower-priced ad-supported plan back in late 2022 seems to be working. It opens the door to more price-sensitive consumers.
Expanding the potential audience.
Exactly. And even if the revenue per user is lower initially on that tier, the growth in advertising is significant. The article mentioned ad revenue doubled in 2024.
And expected to double again this year, 2025.
That's a serious growth engine they're building.
And they're investing in the tech side too, aren't they? The Netflix ad suite launched recently in the U.S.
Right, earlier this month. The goal there is to give advertisers better tools measuring campaign performance, targeting audiences more effectively, making Netflix a more attractive place to spend ad dollars.
So it's not just about having ads, it's about building a sophisticated advertising business.
Precisely. It boosts revenue directly and also diversifies their income away from just relying on subscription fees, makes them more robust.
Okay, another element the article connects to growth, particularly ad growth, is live programming.
This is a big push.
They made splashes with those exclusive NFL Christmas Day games last year. Huge viewership numbers reported, right?
Yeah, around 30 million viewers each, apparently, making them the most streamed NFL games ever.
Why is live, especially live sports, so valuable here?
Engagement. A live NFL game keeps people watching for, 3+ hours?
Longer than the average daily Netflix binge, probably.
Right. The article mentions average daily viewing is around 2 hours. So live sports means significantly more time spent on the platform, which means more ad slots, more value for advertisers.
And they're doing it again this Christmas with the NFL.
Seems so. The article says they plan to air both Christmas games again in 2025. It signals commitment to that strategy.
And it wasn't just football. That Mike Tyson versus Jake Paul fight.
Another big draw. And interestingly, the article points out an undercard female fight actually set a record for women's sports viewership in the U.S.
Wow. And a rematch is planned.
Scheduled for July, according to the source. So yes, they seem to be strategically picking these high-profile live events.
It all feeds back into that content investment cycle you mentioned.
It does. And the scale of that investment is key. The plan is apparently a record $18 billion on content for 2025.
$18 billion. How does that compare?
Significantly more than competitors. And crucially, the article emphasizes Netflix is currently the only major pure-play streamer consistently turning a profit.
Ah, profitability. That's the key differentiator.
It gives them the financial firepower, the flexibility to outbid others for this expensive live content, thanks to their massive scale.
Okay, so let's recap the bull case from the article.
Yep.
Relatively shielded from tariffs, global diversification, dominant market share, strong financials, growing ad business, smart moves into live programming. But what about the stock's price? Is it considered expensive?
That's a fair question. The article acknowledges the trailing price-to-earnings ratio looking backward is higher than the Nasdaq 100 average.
So based on past earnings, it looks pricey.
Yes, but the argument shifts to forward earnings estimates. Analysts expect significant earnings per share growth in 2025 and 2026. Meaning, if those earnings materialize, the forward PE ratio look much more reasonable, especially for a company with Netflix's growth profile. You're paying a premium, perhaps, but potentially for strong future growth.
And the long-term runway, how big could Netflix get?
Well, Netflix itself estimates its total addressable market across streaming, ads, even gaming is around $650 billion.
$650 billion.
And as of the end of 2024, they figured they'd captured only about 6% of that. So from their perspective, there's a vast amount of room left to grow.
Okay, so wrapping it up, the article's bottom line seems to be, if you have some spare cash, say $1,000 you don't need right away,
and you have a long-term investment horizon,
then Netflix, even though it hasn't fallen as much as the rest of the tech market, might still be an attractive place to put that money.
That's the suggestion. The idea is you're buying into a blend of relative stability in this tariff-focused environment, combined with significant ongoing growth potential driven by ads, live events, and their core streaming dominance.
So pulling it all together from this deep dive into the Motley Fool piece, The core argument is that Netflix stand out right now. Its digital model shields it from direct tariff hits, its global scale diversifies risk, its market leadership is strong, and it has clear growth paths via ads and live content.
It makes for a compelling case study in how different business models react to macroeconomic pressures.
It really does. And that leaves us with something for you, the listener, to think about.
How might this big shift we're all seeing towards digital consumption, digital entertainment, how might that fundamentally change which companies thrive during times of, say, traditional economic stress like trade disputes?
Are businesses like Netflix, operating mostly online, just inherently better protected now from these kinds of global economic shifts?
And maybe thinking even broader, what other industries or sectors might show similar resilience because of how they operate in today's more digital, more globalized world?
Definitely some interesting questions to ponder as you watch how things unfold.